Day 26, 3.10, regulation of securities markets. So we will finish the third chapter. Very happy about that. So yeah, let's just begin quickly. We only have like 40 minutes. Trading in securities markets in the United States is regulated by a myriad of laws. The major governing legislation includes the Securities Act of 1933 and the Securities Exchange Act of 1934. The 1933 Act requires the full disclosure of relevant information relating to the issue of new securities. Is the act that requires the registration of new securities and the issuance of the prospectus that details the financial prospects of the firm. SEC approval of a prospectus or a financial report is not an endorsement of the security as good investment. The SEC cares only that the relevant facts are disclosed. Investors must make their own evaluation of the security's value. The 1934 Act established the Securities and Exchange Commission to administer the provisions of the 1933 Act. It also extended the disclosure principle of the 1933 Act by requiring periodic disclosure of relevant financial information by firms with already issued securities on secondary exchanges. The 1934 Act also empowers the SEC to register and regulate securities exchanges, OTC trading, brokers, and dealers, while the SEC is the administrative agency responsible for broad oversight of the securities markets. It shares responsibility with other regulatory agencies. The Commodity Futures Trading Commission, CFTC, regulates trading in futures markets, while the Federal Reserve has a broad responsibility for the health of the US financial system. In this role, the Fed sets margin requirements on stocks, stock options, and regulates bank lending to security market participants. The Securities Investor Protection Act of 1970 established the Securities Investor Protection Corporation, SIPC, to protect investors from losses if their brokerage firms fail, just as the Federal Deposit Insurance Corporation, FDIC, provides depositors with federal protection against bank failure. The SIPC ensures that investors will receive securities held for their account and street name by a failed brokerage firm up to a limit of $500,000 per customer. The SIPC is financed by levying an insurance premium on its participating or member brokerage firms. Security trading also is subject to state laws, known generally as blue sky laws, because they are intended to give investors a clear view of investment prospects. Varying state laws were somewhat unified when many states adopted portions of the Uniform Securities Act when it was enacted in 1956. The 2008 financial crisis also led to regulatory changes, some of which we detailed in Chapter 1. The Financial Stability Oversight Council, FSOC, was established by the Dodd-Frank Wall Street Reform and Consumer Protection Act to monitor the stability of the United States financial system. It is largely concerned with risks arising from potential failures of large interconnected banks, but its voting members are the chairpersons of main US regulatory agencies, and therefore FSOC serves a broader role to connect and coordinate key financial regulators. Self-regulation. In addition to government regulation, the securities markets exercises considerable self-regulation. The most important oversee in this regard is the Financial Industry Regulatory Authority, FINRA, which is the largest non-governmental regulator of all securities firms in the United States. FINRA was formed in 2007 through the consolidation of the National Association of Security Dealers, NASD, with the self-regulatory arm of the New York Stock Exchange. It describes its broad mission as the fostering of investor protection and market integrity. It examines securities firms' rights and enforces rules concerning trading practices and administers a dispute resolution forum for investors and registered firms. The community of investment professionals provides another layer of self-regulation. For example, the CFA Institute has developed standards of professional conduct that govern the behavior of members within the Chartered Financial Analyst designation, commonly referred to as the CFAs. The nearby box presents a brief outline of those principles. The Sarbanes-Oxley Act. The scandals of 2002 centered largely on three broad practices: allocations of shares in the initial public offerings, tainted securities research and recommendations put out to the public, and probably most important, misleading financial statements and accounting practices. The Sarbanes-Oxley Act, often called SOX, was passed by Congress in 2002 in response to these problems. Among the key reforms are creation of the Public Company Accounting Oversight Board to oversee the auditing of public companies. Rules requiring independent financial experts to serve and audit committees of a firm's broad board of directors. CEOs and CFOs must now personally certify that their firm's financial reports fairly represent in all material respects the operations and financial condition of the company and are subject to personal penalties if those reports turn out to be misleading. Following the letter of the rules may still be necessary, but it's no longer sufficient accounting practice. Auditors may no longer provide several other services to their clients is intended to prevent potential profits for consulting work from influencing the quality of their audit. Board of directors must be composed of independent directors and hold regular meetings of directors in which company management is not present and therefore cannot impede or influence the discussion. More recently, there has been a fair amount of pushbacks on Sarbanes-Oxley. Many observers believe that the compliance costs associated with the law are too onerous, especially for smaller firms, that the heavy-handed regulatory oversight is giving foreign locales an undue advantage over the United States, where firms decide where to list their securities. Moreover, the efficacy of a single country regulation is being tested in the face of an increasing globalization and ease with which funds can move across national borders. Insider trading regulations also prohibit insider trading. It is illegal for anyone to transact in securities and thus profit from inside information, that is private information held by officers, directors, or major stockholders that has not been divulged to the public. But the definition of insiders can be ambiguous while it is obvious that the chief of financial officer of a firm is an insider, it is less clear whether the firm's biggest supplier can be considered an insider. Yet a supplier may reduce a firm's near-term prospects from a significant change in orders. This gives the supplier a unique form of private information, yet the supplier is not technically an insider. These ambiguities plague security analysts whose job is to uncover as much information as possible concerning the firm's expected prospects. The dividing line between legal private information and illegal information, inside information, can be fuzzy. The SEC requires officers, directors, major stockholders to report all transactions in their firm's stock. The idea is to track any implicit vote of confidence or no confidence made by insiders. Insiders do exploit their knowledge. Three forms of evidence support this conclusion. First, there have been well publicized convictions of principals in insider trading schemes. Second, there is a considerable evidence of leakage of useful resources to some traders before any public announcement of that information. For example, share prices of firms announcing dividend increases, which the market interprets as good news concerning the firm's prospects, commonly increase in value a few days before the public announcement of the increase. Clearly, some investors are acting on the good news before it is released to the public. Share prices still rise substantially on the day of the public release of the good news, however, indicating that insiders or their associates have not fully bid up their price of the stock to the level commensurate with the news. A third form of evidence on insider trading has to do with returns earned on trades by insiders. Researchers have examined the SEC's summary of insider trading to measure the performance of insiders. In one of the best known of these studies, Jaffe, uh, Jeffrey E. Jaffe, Special Information and Inside Trading. So he wrote a book apparently. Examined the abnormal return of stocks over the months following purchases or sales by insiders. 4 months in which insider information of a stock exceeded insider sellers of the stock by 3 or more. The stock had an abnormal return the following 8 months of about 5%. Moreover, when insider sellers exceed insider buyers, the stock tended to perform poorly. Here we briefly discuss about the regulatory framework under which the capital markets in India function. We then briefly discuss about the two major stock exchanges in India. We also give a summary of the key research papers, the provenance of underpricing of Indian IPOs. Regulations of securities markets. Trading in securities markets in India is regulated under the myriad of laws. The three major laws are SEBI Act 1992, the Companies Act 2013, and the Securities Contracts Regulation Act 1956, amended by Finance Act 2017. Prior to 1992, the control of capital issues under the Capital Issues Control Act 1947 used to decide the amount, type, and price of new security issues. The act was repealed in 1992 under the SEBI Act 1992. The Securities Exchange Board of India (SEBI) was established to protect the interests of investors and regulate the securities market. The SEBI has formulated many acts, rules, and guidelines to regulate the securities market. SEBI DIP guidelines 2000, for example, require the issuance of prospectus that details the financial prospects of the firm. SEBI approval of a prospectus or financial report does not mean that it views the security as a good investment. SEBI cares only that the relevant facts are disclosed. Investors make their own evaluations of the security's value. The Companies Act 2013 talks about the issue, allotment, and transfer of securities. It also discusses about some of the disclosures that need to be made. Thus, for example, Section 62(1)(a) dictates that the new issue of shares must be offered to the existing shareholders in the proportion as nearly as circumstances admit of the shares held by them. However, Section 62(1)(b) and (c) state that a company can issue shares to its employees and outsiders by passing a special resolution to that effect. The Securities Contracts Regulation Act (SCRA) was enacted in 1956 to prevent any undesirable transactions in securities. This act was amended in December 1999 to recognize derivatives as securities through the Securities Laws Amendment. Ordinance was passed in 1995 to lift the ban on derivatives trading. Derivatives trading started only after the SCRA was amended. SEBI guidelines on the issue of shares as per the SEBI Disclosure and Investor Protection (DIP) guidelines 1000. The public offerings of both stocks and bonds are to be managed by the registered merchant bankers. In a typical issue, more than one merchant banker may be associated with the issue. In such a case, the issuing company may have one or more lead managers to the issuant, and in consultation with a lead manager may decide to have some co-managers to the issue. In case there is more than one lead manager to the issue, then the role and responsibility of each lead manager must be clearly mentioned. Once the company decides on the lead manager to the issue, it must enter into a memorandum of understanding (MOU) with the lead manager specifying their mutual rights, liabilities, and obligations relating to the issue. The bankers to the issue advise the firm regarding the terms on which it should attempt to sell the securities. The lead manager ensures that a copy of the MOU memorandum of understanding along with the draft offer document is submitted to the SEBI. The merchant bankers, or investment bankers as they are known in the United States, are also known as underwriters because they underwrite the issues in the United States. In India, however, not all public issues are underwritten. In a typical underwriting arrangement in the United States, the investment bankers purchase the securities from the issuing company, then resell it to the public. The issuing firm sells the securities to the underwriting syndicate for the public offering price less a spread that serves as a compensation to the underwriters. The procedure is called a firm commitment. The underwriters receive the issue and assume the full risk that the shares cannot be sold to the public at a stipulated price. In India, the underwriters come to the picture only if the issue is not fully subscribed. Of course, the lead manager may insist that the syndicate of underwriters pay the entire money before the issue is made. If an issue flops and the underwriters not buy the shares they promised to buy within 60 days of the closure of the issue, then the company has to refund the entire money raised from the public. IPOs, initial public offerings. SEBI guidelines specify conditions that all companies must follow in order to make an initial public issue in India. First, the company must have a net tangible assets of at least rupees 3 crores in each of the previous 3 years. Second, the company must have a minimum net worth of rupees 1 crore in each of the immediate preceding 3 years. Third, the company must have a track record of distributable profits in at least 3 out of the previous 5 years. Fourth, in case the company has changed its name in the last 1 year, then at least 50% of the revenue of last year must have come from an activity suggested by the new name. And finally, the issue size should not exceed 5 times the pre-issue net worth of the company. If any unlisted company does not satisfy the above criteria, then it can make a public issue only if both of the following conditions are satisfied. One, the company uses book building route to fix the issue price through a book building route, provided 50% of the net offer to public is reserved for the qualified institutional buyers, QIBs, failing which the entire issue proceeds are refunded. This condition can be relaxed if the financial institutions have contributed at least 15% of the total project cost and at least 10% of the total issue amount is reserved for QIBs. Second, the minimum face value of the shares after the issue should be at least rupees 10 crore. This condition can be relaxed if there is compulsory market making. For at least 2 years after the listing of shares in April 2007, SEBI also made it mandatory for the unlisted companies to get a grading of the IPOs from a credit rating company. However, in 2013, IPO rating became voluntary, and SEBI finally scrapped IPO rating in June 2018. Companies pricing the issue through book building process can either go for 75% book building route or 100% book building route. In the former case, the issue price is decided first, and the remaining 25% of the shares are sold to the retail investors at the cutoff price. In this case, the book runner circulates the draft prospectus to the potential institutional buyers who are eligible for the firm allotment and the other intermediaries who are eligible to act as underwriters. The book runner maintains a book containing details of the investors, the price they're willing to pay, the number of shares they're willing to buy that price. Based on this, the book runner and the issuing company decide the price at which the issue can be made. In case the company goes for 100% book building route, then the final price issue is determined through a bid process. The retail investors need not mention the price at which they make a bid. They can instead bid at the cutoff price. All the investors have a right to reverse the bid price. Circuit breakers. In order to curb excessive market movements, SEBI has mandated that exchanges like BSE and NSE should use market-wide circuit breakers, MWCBs. The MWCB system applies at 3 stages of the index movement, either way at 10%, 15%, 20%. The break is triggered by movement of either Sensex or Nifty, whichever is breached earlier. In case of 10% movement in either index, Nifty and Sensex, there would be a market halt of for 1 hour if the movement takes place before 1 p.m. In case the movement takes place between 1 p.m. and 2:30 p.m., there would be a trading halt for 30 minutes. However, if the movement takes place after 2:30 p.m., then the market will continue as usual without a trading halt. In case the movement is 15%, then trading will halt for 2 hours. If the movement takes place before 1 p.m., the movement... See, this all stuff is very, very... it's like too detailed to the point that I'm not gonna remember. It's like, it's like too specific and stuff. Like, what am I gonna do with this information, So, I'm just gonna glance over it, to be honest, and then I'm just going to... it's all very like lawyerly stuff, lawyerly stuff. It's like I'm not supposed to like know all these details, like I'm not a lawyer, like I'm not supposed to know what conditions a company. I mean, maybe I am. I don't know, but like I don't know. It all feels like too specific for me. You know what I'm saying? But yeah, let me. You know what? Let me just read the summary and finish this chapter off nicely, because that stuff is like too specific for me, and it's also like not that useful information. And if it comes up in the questions, it comes up in the questions, and we'll answer the questions, and we'll deal with it if it comes up in the questions, right? But I don't really think that that information, um, there's like any point in reading that information. First of all, because it's like too specific, and um, it's not really like, I don't know, like it's too specific basically. So anyways, like what is this about? Like in case of 10% movement in either index, there would be a market halt for 1 hour if the movement takes, like it's too specific. It's like too situation based. And I'm just not going to remember that, so there's like no point in that. I'm not going to remember most things, but like at least I understand stuff. And that stuff is just like, what are we doing here? Like if there's a 10% shift, then there's going to be a 1 hour halt. Like how is that information relevant, for me? That's like a very situation based, um personal, not personal, but like situation, for the situation based specific stuff, which is not applicable all across the board in a sense. Anyways, a summary. First point: firms issue securities to raise capital necessary to finance investments. Investment bankers market these securities to the public on the primary market. Investment bankers generally act as underwriters who purchase the securities from the firm and resell them to the public at a markup. Before the securities may be sold to the public, the firm must publish an SEC approved prospectus that provides information on the firm's prospects. Second point: already issued securities are traded on the secondary market, that is, an organized stock markets and on over the counter markets, and occasionally for very large trades through direct negotiations. Brokerage firms holding licenses to trade on security exchanges sell their services to individuals, charging commissions for executing trades on their behalf. Trading may take place in dealer markets via electronic communication networks or specialist markets and dealer markets. Security dealers post bid, and ask prices at which they are willing to trade. Brokers for individuals execute trade at the best available prices. In electronic markets, the existing book of limit orders provides the terms at which trades can be executed. Mutually agreeable offers to buy or sell securities are automatically crossed by the computer system operating the market. Nasdaq was traditionally a dealer market in which a network of dealers negotiated directly over sales of securities. The NYSE was traditionally a specialist market. Today, however, trading in both markets is overwhelmingly electronic. Buying on margin means borrowing money from a broker to buy more securities that can be purchased with one's own money alone. By buying securities on margin, an investor magnifies both the upside potential and the downside risk. If the equity in a margin account falls below the required maintenance level, the investor will get a margin call from the broker. Short selling is the practice of selling securities that the seller does not own. The short seller borrows the securities through a broker and may be required to cover the short position at any time on demand. The cash proceeds of the short sale are kept in escrow by the broker. The broker usually requires that the short seller deposit additional cash or securities to serve as margin collateral. Securities trading is regulated by the Securities and Exchange Commission (SEC), by other government agencies, and through self-regulation of the exchanges. Many of the important regulations have to do with full disclosure of relevant information concerning the securities in question. Insider trading rules also prohibits traders from attempting to profit from inside information. So that was pretty much chapter 3. We are done with the third chapter, how securities are traded. I'm very proud of myself for being able to come up to this point, even though it has taken a long time. By a long time, I mean, I don't know, maybe a month and a half, something like that, maybe. And yeah, probably like that only. And probably more than that, maybe. But like either way, anyway, we got here, and this is a point that I've never reached before ever. And I hope that in this winter break I can keep continuing to do this and get in like a flow state every day of just being invested in this world, because I feel like that's really what I need to do. And to be honest, at this point, that's all I have the option to do. But that doesn't mean that I don't want to do it. Obviously, I do want to do it. So this is the best sort of situation that I have, and I don't really see any other thing for me in life to do so far. I mean, if I do, then I'll switch. Hopefully, I have the courage to do so. But so far, this is it for me. I love thinking about this stuff and fantasizing about it, and romanticizing also about it. Like, I don't know, like I'm Patrick Bateman or like Bruce Wayne or something. But like, I know that's childish and stuff, but yeah. Anyways, too much yapping. After this video is done, the next one is going to be day 27. Again, these like the days are just like parts, and since I haven't done them in so many days, so I'm figuring it's just like sort of track. And yeah, since I don't have any classes because it's the winter break, I'll be recording like way more videos, like maybe like, I don't know, like 10 videos a day or something like that. And yeah, it's good. Now in the next part we will solve the questions, however many we can, because we don't have the laptop. So actually that's actually what I'm thinking about. You know what, maybe I won't solve the questions today. Maybe this will be it, and I'll just do some journal work, because I don't have my laptop. So this will be like a big problem, because first of all, there's a lot of calculations, and also like I have to like type in the laptop in the Google Doc I made for the questions and stuff for this book. And you know, if I don't have that, then there's not really any point. So now I'll be continuing day after. When I come back in the evening, I'll record a long session in which we will do the exercise questions for this chapter, the third chapter. And then yeah, then we should be fine to proceed with the fourth chapter, which is mutual funds and other investment companies, which is my dad's business actually. So excited to get into that in a few days. But till then, we will be looking at the questions. And yeah, thanks.